Chege. Today we are going to run Dividend Trap explained. This is a recorded session, it's not a live session. No? We run what it is, what to check before buying dividends stocks, and checking whether the dividend is a trap or it is sustainable. And if you have any question, you can always reach out to me on WhatsApp. And at the end, I will explain to you I usually share training materials and also discussion. No? So what is a dividend trap? Dividend trap happens when a company pays dividend that may look attractive in terms of even dividend yield, but it's not supported by real cash. They are not paying from the cash they have generated, or there is no sustainable profit. So the company is paying yes dividend, but it's not making profit, enough profit that can be sustained. Maybe they just sold an asset, which then they decided let's share this out. Or just like what happened with Umeme, they are paid some money from government as a payout, as a buyout, then they give it as a dividend. Those are not the stocks you want to buy. Or they are borrowing to pay dividend. So eventually what may happen, one, they may cut the dividend in near future. So you find the dividend starts to decline after some time and eventually stop. They also borrow to maintain payout. If they have been paying, they may want to remain on the books as one of the most paying dividend stock. So they may start borrowing and you find they incurring debts to pay a dividend. Or in the future you may find it erodes shareholder value. And this may happen when shareholders realize this dividend is not sustainable and they start offloading shares. So the prices go down. Eventually you may find it's trading below the recommended prices in the market, and eventually it is suspended. So there are formulas that you can use to check for dividend stock. Today we are going to learn the main one, very simple, doesn't require any calculation. Most of the companies which are strong in the dividend arena, they usually give these values. It's called free cash flow. Free cash flow, as the word says, is the cash that is left after the company pays its own expenditures. From the cash it's generated from its own operating activities. And this is not in terms of profit. It is in terms of real cash, what they have in the bank. So how then do you calculate a free cash flow? You first check on the financials, financial results. You go to statement of cash flow. Here you get net cash flow from operating activities. It's called CFO. So after deducting most of capex, capital expenditure, there is that net cash that is left from the operating activities. You need to deduct capital expenditure, whatever they intending to pay, maybe things that support their business. It's called capex. The difference is what is called free cash flow. So it tells you how much real cash is left to the company. One, to pay dividend if it is not already factored in net cash operating activities. Reduce debts. That is, if they have debts and it has not been factored in net cash from operating activity, then they may use. Then that amount can be used to pay those debts. And also invest in growth if it's not included in the capital expenditure, maybe in the near future. So let's say how, with an example of 3 companies, Equity Bank, Safaricom, and KPLC. We are looking at their latest financial results. So if you go to Equity, full year 2024 audited results, their CFO, that is cash from operating activities, it was around 170 billion. Capital expenditure, that's what they are using to buy equipment and also other expansions, is around 7.4 billion. So the net balance is 162.6, which is free cash. So out of these, if they had not included it in in the CFO, then the dividend paid was around 15.1 billion. So if you are to do dividend divide by FCF times 100, you get FCF. It tells you how much would be paid dividend from free cash flow. It's around 9%. So that tells you Equity Bank dividend is fully backed by cash. Safaricom year 2025 full year results, that's for financial year 2024, was around 360 billion. Capex it's 91 billion. So the difference between now the CFO and Capex, and also deduct other operating finances, they were left with FCF of 89.9. So out of the 360, is part was used for year expansion. If you get the full year results for 2024, you find FCF is around 89.9. Dividend paid was 48.1. So if you look at the FCF payout, would be around 53% if it's not included in the amount that was paid out of 360. These are still safe dividend, but with a high capex. Notice it's around 91 billion. KPLC for the financial year that ended June 2025, a CFO 39.7, capex 29.5. So FCF is around 20.2. Dividend is around 1.56 billion. So all these are in billion. So FCF payout was around 15%. Yes, for this KPLC dividend is covered, but there is a risk trade. We will see in the next slide. This is just a summary of the key points you pick from. But you find FCF is already calculated, the net free cash. So it's calculated in the statement of cash flow. So what do you then check? Metrics, FCF payout. The formula is dividend divided by FCF times 100. It should be less than 60 if the company is to maintain that payout. That tells you there is a cash strength. They are able to pay dividend and maintain some cash. Then you have earnings payout ratio, which is dividend divided by profit after tax. Profit after tax, you can get it from P&L, profit and loss statements. It should be less, that percentage should be less than 70%. So dividend divided by profit after tax times 100 should be less than 70%. It means profit covers the dividend. Then there is a dividend cover, which is profit after tax divided by dividends. It tells you about profit safety. Then there is cash flow coverage, CFO divided by dividend. It also tells you cash safety. So we go to the example we had seen earlier and see how to identify whether it's a dividend trap or not. We start with Equity Bank, which you said is fully cash backed. Its profit after tax is 48 billion, FCF 162 billion. Then dividend paid was around 15.1. FCF payout 9%. So this dividend for equity is fully financed from its operations. They are not borrowing or selling any asset. Safaricom profit after tax is 84 billion, FCF 89.9. Then dividend is around 48.1. The heavy capex on Safaricom was largely due to the UP rollout, but they still have a solid cash generation and their dividend yield is usually high. Then you have Kenya Power. The result they announced was actually a dividend trap warning. Why? Profit after tax 24.4 billion, FCF 10.2, dividend is around 1.56 billion. You note that from their financial year results and cash flow, cash in 2023 and cash in 2024, it has declined from 10.3 billion to 7.7. Financing costs 12.9, and their liabilities are a bit high, 24.9 billion. Ideally, the dividend they paid, if you are to do now the finance cost, you deduct from 7.7, that's 12.9 billion, you find they are actually funding most of the operations from the cash that was just generated in 2023. That is cash reserves. That may tell you the dividend heavily relies on previous year's reserves. And it is on high debt, and financing cost is also high, if you notice. There is also the foreign trade in cash, meaning the dividend may not be sustainable in long term, but it is here to make a decision. For a sale decision, I always tell clients, just go to portfolio valuation, check whether you have made profits. For a buy, there are so many other factors you check alongside dividend trap. So red flags of dividend trap, one of them is where dividend is more than FCF. It means company is paying from its debts, so it is incurring debts to pay that dividend, or from its reserves from the previous years. Then if there is a rising debt and constant dividend, if debts are going up but they are giving dividend, that is just artificial. If there is a falling CFO but constant dividend, then if they are not generating enough money but they are giving dividend, then it is unsustainable in long term. Then where you have a negative cash change despite profit. Yes, you are making profit but there is a decline. That's a trap, like KPLC. If they don't improve in cash collection, then you may find that dividend may go down or even suspended. So what then do you take away from these three companies? You can tell Equity is a strong cash-backed company which is giving dividend. So it's a reliable compounder. They usually give around 4 Kenya shillings dividend, which you can always reinvest to create a compounding effect. I've done those videos on this channel. Be sure to check and a playlist for my wealth guide KE. Safaricom is stable, but its capex is high, but mostly it's because of its expansion in other regions and also other products. So there is a balanced income and also growth because of these expansions they are doing. So in future you may find they have reliable cash to even give a higher dividend, and price may appreciate. For KPLC, it's a bit fragile for now, risky. So you just monitor closely. And with what happened today with Chege, expect some price instability in coming days. Hopefully the Chege announces results the same way they were reached, without any changes, because that may erode investor confidence. Remember, Chege and KPLC are in the same sector. Then key lessons: always look beyond profits. Don't look at the profit the company is making. Check cash flow and also debts, among other factors. There are so many that you need to check. So a dividend that looks very high but isn't backed by real cash, it will destroy your wealth over time. So you may buy shares, price appreciate, but if you don't sell, remember you are not realizing those gains. If price goes down, then you make losses. So a true dividend safety is backed by profits plus cash flow and low debts. If you have any question, you can always reach out. Remember, if these videos are helping you, like and share with your friends and subscribe for more. And I'll leave link to one of the detailed tutorial on dividend trap and analysis on the 3 stocks, so that you can get details of how I calculated all the figures that are there. The link is in the description of this video. Also join my WhatsApp community where we discuss and also learn a lot that is outside there. It's called my Wealth Guide KE. That is the WhatsApp community. It's not affiliated to any broker. Even this channel is not affiliated with any broker. I only happen to work with one of the brokers. I have 17 years of experience in NSE. And for those clients who are sharing out materials from those wealth guide, please don't copy any broker. As I've said, the materials here are not affiliated to any broker. It is my independent analysis and trainings, just to help you grow outside the normal broker trainings. And soon I'll be going live on TikTok, Facebook, Instagram, LinkedIn, X, and other social media using the same name, My Wealth Guide KE. This channel name is Gentle Search Studio, but I'm in the process of rebranding because the channel purely trains on how to make money online and also how to grow wealth at NSE, offshore, international markets, funds, and other investment options, and how to prepare for your retirement and also save through pension. You can always support this channel through that Pochi number, my number. I'll be happy for you to help me grow out so that I can be able to give you more detailed and informative lessons. I'll be creating recorded sessions within the days I'm not doing live training, but every Wednesday, Friday, Saturdays, and also other days, I'll try and see how now I can start doing frequent training so that we understand market. Especially now we are going to a season where prices may go down. It's time for you to buy. You need to buy what you need to know what you are buying. Let's meet in the next one, and thank you so much.